Hey everybody, this is Jim at SP500chart.com. It's about 2:30 on Sunday afternoon, April 13th, 2014. Let me read this to you, then we're going to look at the past week in all of its glory, and also look at Friday and see if we can piece together what might be going on with this S&P chart. Before we do that, I want to remind you that the website and this video are for educational purposes only. Nothing stated at the site or in the video is intended to be used as investment advice. I can draw lines on charts, but you have to draw your own conclusions from your own research and make investment decisions that are suitable for your personal financial situation. I am not a licensed financial professional. I'm just a guy who draws lines on charts. So let's take a look. Okay, starting out here looking on a 10-minute chart. We began the week actually after having come off of an all-time high that was touched on the previous Friday, but you'll recall that we sold off of that high pretty swiftly, came into Monday, sold off more, rallied just a bit for 2 days, and then had another 2 days of selling pressure. Now, if you look at this on a 10-minute chart, it sort of looks like, and I know we had this little inverted head and shoulders here that made it look like we might bounce in that 1840 to 1850 range, but that was short-lived, sadly. So we now are underneath our support that we had enjoyed for almost 2 months at 1840 to 1850. And I think it's probably pretty safe to say that that we would look upon that now as being likely resistance. So there was some technical damage done this past week, but I'm going to back out just a little, well, actually back out a pretty good bit, and let's put this into a little bit different perspective. Now we're looking at this on a 1-day chart, and you can see that we have numerous spots along this chart where the markets would give up a handful of percent, and it's not, it just ain't that big a deal. I don't think we start to sound the warning klaxon unless we break this blue line right here, and even a break of this line may not be the end of the world, because we've got another support line that if we get down there we can take a look at this line, and because there's a little bit of a parallel to this line back in the bull run that began in 2000. So let's just put this into perspective, realize that the markets have to take breathers from time to time. You can see that even though our last really nice run, I would say, began in the fall of 2012, that along the way we had a couple little dips in a 6-month period. Those were very minor. What we've experienced here lately has been more like on the order of what we saw in the summer of 2013, again the late summer of 2013, again in the fall of 2013, around the first of the year of 2014, and now what we're seeing currently. What's interesting in all of this is, let me get rid of my moving averages. Those are up there from another chart. Is if you look at this trend line right here, and you extend that on out, we've got 1, 2, 3. This not quite, but 1. And actually, if you want to take this on back for a bit, you could almost make the case that this trend line has some support back here too, but it's much more clear once we get around this 1600 mark. I think that this trend line does appear to have some technical significance to it. And if it continues to do so, we are very close to testing this line with where the S&P is currently. Then that would actually get tested this week with a move to about 1800. And if you've been following these videos for a while, you know that we've been saying for quite some time now that a move underneath this 1840 to 1850 range is likely to set up a test of roughly 1800. And I base that upon, not upon this height right here. I think this was a false breakout. But I would still go with the general height of what we were stuck in between 1840 and 1884. And we're going to split sort of the difference here on in this gray area. So now that we've broken down through this, you can see where the general target area is down around 1800. I'm not measuring from the very bottom of this, and I'm not measuring from the very top. I'm just sort of averaging this gray spot right here to get that minimum target. Another thing that's a little interesting, by the way, in general terms, what an ugly week. You know, we did identify this little inverted head and shoulders pattern, and it did what it made its minimum target, but instead of taking the S&P back up for a test of 1884, it failed right at its minimum target of 1872, and that's when we had those 2 days of significant selling. And you can see that was also a back test of this extended trend line right here. This, well, I have to go out to like a 1 hour chart. This speculative, I called it, speculative support line. So, you know, I threw this up only because it was parallel to what we had going on up here at our tops. Turns out once we broke through that, we did back test it, which sort of lends a little credence to that line having some, that it wasn't a bad idea to throw this up there. Sadly, it broke right about the time we got it on the chart. Boom, it broke. Now, if we look at a 30-minute chart, the other thing that's a little interesting is the fact that we had been, in the latter part of March, been bounding between a couple of trend lines. Here's your resistance, here's your support line. We got over that, came back for that little back test of this line that got a little deeper, rallied back again, and where we ended the day last Friday is very near this descending support line. So the question I would have is, does that mean we may bounce there? Let's wait and see. So far it looks like we might, but I don't have the futures market yet, so that's not going to start trading till 6 o'clock. And frankly, I don't know how much I trust late Sunday futures trading anyway. It can really give you a head fake. So, going forward, I would be looking for a sign of some firming up around 1800. Additionally, we now have a good significant resistance line on the chart, as evidenced by our all-time high of about 1897 or so, or maybe it even reached 90, about the high in the 1890s, and then that back test right here that got to about 1872. I would be looking at this line as being as the first test. Well, I want to say maybe not first test, but if we can get up over this line right here, then I think our selling could be over. The pitch of this line looks about right. It's a little bit steeper than what we rose in, and selling tends to be a little bit steeper than buying. So let's just see if getting over this makes, if that creates a bottoming pattern for the S&P to firm up and to start to rise again. I thought maybe getting over this line right here would help us. You remember we got over that, and I may have even mentioned that maybe the selling would be over if we could get over this line right here, but that proved to be, frankly, a mistaken idea. This was probably just a little too steep for us to have a reasonable expectation, and we weren't rewarded with a breakout over this first descending channel off of this high. And in my defense, if I saw this again, I would probably have to say the same thing, because it took us down into our support range, and then we started to firm up. It's just that we then were unable to set a new high, and instead we started to get slammed down again. So this whole little area right here for this 2-day period, in retrospect, probably we would call this a bear flag. Swift move down, little bit of a move up, then another swift move down. Interesting to note, if we measure the depth of that move down, that's a pretty good measurement right there. And then we measure the depth of the second move down, they are almost equal. So the old adage about maybe the flag flying at half-mast, I'm not quite ready to say that's going to be the case, but that often does pan out to where you have a leg down, a recovery, and then another equal leg down. Maybe we get a bounce down here and we can start to re-challenge this 1840 area again. But right now, guys, ugly week. The week in general was just, I mean, we knew we were probably going to expect some weakness, and I thought we would be getting down to the 1840 to 1850 range when we broke underneath this 1884. But the fact that we had that second leg down was really kind of the kick in the teeth. That I did not foresee. But here we are. It's a fact. It's a done deal. Let's now see if we can firm up around 1800 and then come back, re-challenge the mid-1800s, and maybe get enough steam to get back over this red line, or to get over this red line, and perhaps we see that the weakness that we experienced this past week, as we look at this chart, maybe we just add what we had this past week to a rather a quite ordinary event. So guys, that's your video for the week ending April 11th, 2014. Thanks for taking time out of your day to watch this. Thank you if you're a subscriber. I really do appreciate your support. And like I said, this was an ugly week, but it's going to happen from time to time. It's got to. In the long run, if we firm up and start to turn up in the other indexes as well as the S&P, this could end up being a good thing. So all is not lost yet. Let's keep an eye on 1800, see if we firm up there, and then we'll just we'll do a video after each day's close as we normally do, and if there's new information on the chart, we'll digest that and try to put that into context. Thanks again for watching. Take care.